Welcome to the InterMarket Analysis video update. This is a video that I prepare once a week, and it goes alongside of the other videos that I put out. I do a daily video, of course, each day. I also do a weekly video, and then there's this video. And then after this, I do what I call the deep dive video, where I look at the charts that maybe I didn't talk about in the daily videos, put them into one video just in case we might get some additional insight. This is being prepared for Monday, September 11th. Before I get started in the rest of the video, please be aware that from Monday through Wednesday of this week, the 11th through the 13th, I will be doing a free online course. It'll be 1 hour spread out over Monday, Tuesday, Wednesday. In the first session, I'll be talking about my approach to technical analysis. I don't show a lot of charts in this class. I mainly talk about the path that I went through that led me to how I approach technical analysis, and it's really been very beneficial for myself and for other people who learn from me. The second hour, I'll be talking about different strategies. Now, when I did this class a week ago, I went a little bit long in that session. I may try to cut it back a little bit to keep it to 1 hour, or if I'm not quite done, I may carry it over into the third session, where I'll also be talking about support and resistance. I will be doing this using Zoom, and on the YouTube community tab on Monday, I will be putting a link there to be able to contact and connect with my Zoom account. So if you're interested in that, please feel free to take advantage of that. And then after we do the session, I will be posting a recording of each hour, so you can go back and rewatch it, or if you missed it, you can look at it then. The first area that we look at with intermarket analysis is S&P 500 valuation. We look back on a historical basis to see what were valuations versus the current price of the S&P 500. We do that in a couple of different ways. And then we look forward, because that's what the stock market uses. What are the analysts coming out and saying as far as their forecast for earnings? Because it's ultimately earnings that drive stock prices. There might be news here and there, and there's events that happen in the market, but longer term, it comes down to earnings. The first area that we look at looks backward, and we have a PE ratio of 10, 15, and 20. 20 and above, the market is considered to be expensive on a historical basis. Between 11 and 19, it's fairly priced, and 10 or below is considered to be inexpensive. We can see on this chart, the black line is the S&P, where we have been coming down lately, but at the same time, the dashed red line, that's the PE ratio of 20. We're still above that. And then I measure this down below as well, and I'm going to need to turn on my laser pointer here. And we can see when we're above the zero line, that just means that on a historical basis, the market continues to be expensive. Now, we've been this way for quite a while now. If you can go back all the way a number of years where we've been above this red line, even when we went down in the whole COVID plunge, we were still considered overvalued on a historical earnings basis. So we don't really use this to make our decisions. We just want to be aware of the climate that we're in right now, knowing that as a whole, on a historical basis, the S&P is considered expensive. We can also compare that by looking at different events that have happened. Going back to 1980, we have different things. And what were the valuations at that time? Sometimes we were still overvalued, and then we saw the market really decline, like we did during the whole great financial crisis. Then as we were running up after that, we can spend many years actually being in an expensive type of an environment. Up here at the very top, that's where we're at right now compared to the PE ratio of 20. Then we look at another version of historical PE studies. This was developed by Robert Shiller, where he looks at a more average over a period of time and compares it to get it so it's more smoothed out. And instead of being an anomaly or some kind of an outlier, we get a general sense of the valuation of the market. Right now, based on his calculation, we are at 30.64. To get some perspective, the median and the mean have been between 16 and 17. So we're almost double what the historical value has been on this chart. Also, to give us a little bit more of a reference point, we can see Black Tuesday, that was the 1929 crash, and we're just a little bit above that now. We also had the 1987 crash where we're quite a ways above that. So again, just to give us an idea of where do we stand on a historical earnings basis. But as I always say, the market doesn't use that. The market looks forward. So we've developed that same basic scale, 10, 15, and 20, and then looking forward, how is the stock market looking? Right now, the S&P is coming in at 18.6. So we're above the 15 level, but we're below the 20 level, and that's justifying higher prices. We also compare it with the mid caps, which are under 15 at 13.5. Then we look at the small caps, which is even lower, and they've been really having some problems lately. They come in at 13.2. Then we take all of these and we put them together on one chart so we can get kind of a perspective of this. And there's different colors on here, and they tend to go up and down in tandem with each other. But we just want to look at this from a technical analysis perspective just to give us an idea. Then we take two different indexes that we use for the small caps. There's the Russell 2000, which is the red line, and then the S&P 600 small cap index, which is the blue line. And then I tend to use the blue line more because that lines up with the 10, 15, 20 valuation levels. Well, when you look at the Russell 2000, they calculated a bit different. So it may end up looking like it's actually quite expensive when really on a relative basis, it would be fairly valued or even getting down to the cheap end. Another area that we look at is growth versus value. When growth is going up, that's when we want to buy low and sell high, and the indexes and stocks are usually going up. When we hit some trouble, that's when the value area comes in and takes over. And then we can look at some different studies to compare the two. The first thing we look at is a pure growth index, where recently in August, believe it or not, even as we were coming down, we did see a golden cross with this particular index, showing that this growth index is in an uptrend where it had been in a downtrend for quite some time. Then we look at a value index, which almost came up to a golden cross, but it's been under a lot of pressure as we go throughout 2023. So growth is in an uptrend and value is continuing to be in a downtrend. Then where it gets interesting is when we compare the two. We take a ratio on the top, growth versus value, showing that growth is outperforming. And then on the bottom, we take another look at value versus growth, where value is underperforming. And the reason why I do this and look at multiple charts and ETFs and indexes, they're all calculated slightly different. And some of the components that we use, they're weighted in a little different way. So we want to see confirmation across the board here, saying, is growth outperforming or is value outperforming? For most of 2022, value did better. Well, as we're switching back more positive, growth has been outperforming in 2023. We look at an ETF where it shows where growth had been underperforming and now it's starting to outperform. Then we look at an inverse of that same chart showing how value is now underperforming. And then we look at some other indexes showing how growth continues to outperform and how value is underperforming, or we could say growth is outperforming still. Another index study that we look at shows that growth is outperforming value. And then we look at a different study with some different lines on here to show where growth is showing a lot of improvement. Now, we've hit kind of a snag in the market recently, and this ratio is going down a little bit, but it's still having a tendency to hold up in the longer term. We look at an inverse where we look at value versus growth, where it has been underperforming even though it's bounced back up recently. We look at the small caps. They're an important part of the market, and they've really been suffering a lot lately. But still, when we compare small cap growth to small cap value, we're still in a longer term uptrend, even though we've been going sideways to slightly down since about the early part of spring. We look at mid cap growth versus value, which this has been some of the internal strength that we've seen in the market. The mid caps have held up fairly well, but they've run into some recent problems as also where growth continues to outperform value. This is the important one if you are involved in the S&P 500, and that's mainly the thing that I focus on, where we look at the ratio between growth and value, where growth is outperforming, and we were trying to break out here. We've seen some recent weakness as the markets ran into some difficulties, but this is still holding up longer term. We also keep an eye on inflation, and we look at a number of different ways to study inflation. On top, we see the CRB index with a monthly chart where it's coming back above this moving average. We're seeing a real shift on that. We're seeing the daily charts and the weekly charts starting to turn positive. That potentially could be inflationary. Then down on the bottom, we look at inflationary measures and take a ratio compared to deflationary measures, and then look at it on a monthly chart where this is continuing to fall. So this ratio is suggesting that inflation is not necessarily a problem, but this is a monthly chart. It can take a while to update. And there's some other areas of the market that are coming in, specifically interest rates going up and oil going up right now, that are producing some inflationary pressures on the market. And I'll show you charts of those. Here's the CRB index, where for a lot of 2022 and into 2023, it had been in a downtrend, where now we're starting to come back up into an uptrend. And we're seeing a golden cross also on the weekly chart of the CRB index. We look at the Baltic Dry Index. What does it cost to ship products from point A to point B, specifically in the Baltics? And this is continuing to be in a downtrend. Now, other people will look at this index and study it in slightly different ways. They'll shift things forward when they're comparing it to the S&P. I just look at it for what it is right now and what it's trying to tell us. And this is not necessarily signaling that inflation is a problem. Some other markets that we look at that are way outside of the stock market. Here's aluminum showing that it's in a downtrend, where corn continues to be in a downtrend. Wheat is in a downtrend. We look at fertilizer. That's pretty important for growing things. It has been declining, but lately we've been seeing it start to come back up. Oil, this has been in the news a lot lately, where it's starting to break out. There was news this past week that Saudi Arabia and Russia, who've already been cutting back on their oil production, well, they're going to continue that throughout the rest of 2023. That's making the supply a lot less, and the demand is still really great. So that is pushing oil prices up, and that could be inflationary. That can also carry through into gas, and we feel that every time we have to fill up our cars or trucks, where, excuse me, where gas had been in a downtrend, well, now it's starting to go in an uptrend, but it's been rather choppy lately. We also keep an eye on diesel. This is, what do railroads need? What do trucks need to be able to ship products around? As diesel has been going back up, that means it's more expensive. They're going to eventually have to have those costs be forwarded to the companies, who then forward them onto the customers, and that could potentially be inflationary. Heating oil, which is starting to go back up, which is strange because we're in the middle of summer right now. It had been in a downtrend, but it's starting to really turn and be in an uptrend. Natural gas also continues to be in a downtrend, even though it's starting to bounce back up. We look at copper. This tends to be a barometer for the economy. When copper's doing well, then folks think that looking forward, the economy should be stronger. When copper is in a downtrend, it looks like the economy may be weaker. We've been chopping around quite a bit, but we're getting to the point now where we're seeing a death cross on the daily chart of copper. And we're also seeing the weekly chart beginning to show some weakness. We look at copper to gold. Copper measures the economy to see how good or bad it is. Gold has a tendency to do the opposite. In difficult economic times, gold tends to do well. In good economic times, gold may lag. So this ratio right now is showing that copper is dropping below this moving average and underperforming gold. We look at this also on a longer term chart, where the black line is a long-term look at the copper to gold ratio. Then we plot in red right here, the 10-year yield, and green is the 2-year yield, where if looking back over time, sometimes they get kind of far apart from each other. But if we look back over the last 10 or 15 years, all of these lines tend to move in the same general direction, and they tend to not get very far apart from each other, even though they're on different scales. And when they do, then we tend to see some kind of a reversal that happens. Well, they've been spread apart now for quite a while, most of 2022 and into 2023. And we're also noticing that they're not necessarily going in the same direction. So we're seeing a longer term shift in the economic climate. We're not quite sure what that means at this point. We just want to keep an eye on this and then be aware that some changes might be taking place. We look at gold by itself, which continues to be in a longer term uptrend, even though it's seeing some recent weakness. It's come back down to its 200-day moving average. Silver is also really choppy all over the place. It's in a longer term uptrend, but now it's dropping below its 200-day moving average. Then we look just to get some clarification here. Do gold and silver tend to move in the same direction, or do they go in opposite directions? Well, on top, we look at the closing value of gold, and then in the middle is the closing value of silver. And then we look at a correlation between the two. And when this is really going up, that means that, yes, they are, in fact, going in the same direction. We might get into some strange periods where this correlation really drops, but it tends to not last very long. We can also take that a bit further. We have the gold to silver ratio on the top. And when this is going up, that means gold is outperforming. When it's going down, that means silver is outperforming. Now, individually, they might be in uptrends, but this is just a ratio showing which one is doing better. We can take that to the next level by looking at the US dollar index and make some general observations. When the dollar index is going up, like we see here with the blue line marking this, gold tends to outperform silver. When the dollar index is going down, silver tends to outperform gold. Now, as I said, they both can be in the same trend and they can both be going higher or lower. It's just which one is performing better. And then on the bottom, we take a correlation between the top chart and the middle chart. And this tends to have a really strong relationship, but we're seeing that really drop off right now, suggesting that there's some kind of a shift going on in the market. But this relationship is getting back a little bit stronger now. We look at the US dollar index. It's really been doing quite well. It fell below 100 back in early July, and then it's really been screaming back. Now, we're still in a longer-term downtrend, but we are seeing some improvement here, and this is also putting some pressure on stocks. On the weekly chart, we've already crossed over positive, because when we had the death cross that went negative, the two lines between the of the moving averages didn't get that far apart from each other. So it didn't take as much for them to cross back over positive, where this chart is taking a little bit longer period to do that. We keep an eye on other currencies. We look at the euro, which has been down lately compared to the dollar, since the dollar's been seeing some strength. And then we have three currencies here: the Japanese yen, which is underperforming the dollar, the euro, which lately has been underperforming, and then on the bottom, we have the dollar index. We look at the Japanese yen to the US dollar on a separate chart, showing that the Japanese yen is continuing to underperform the dollar. We look at the British pound. It's continuing to outperform, but it has seen some weakness and it's coming back down to its 200-day moving average. We look at some different indexes. This is the S&P 500, which is a weighted index. So the big mega caps, they have more of an influence. Well, then we have the equal weight index, where all of the stocks in the S&P are treated the same. When this red line is above the black area, which is the S&P 500, that means that the broader market is outperforming the S&P. When this red line drops below the value for the S&P weighted index, that means that we're underperforming. And that's what we've been seeing a lot throughout 2023, as you hear about the Magnificent Seven or the Great Eight and all these big companies that have been really outperforming the rest of the market. And this just correlates with that. We look at a ratio between the S&P 500 and the CRB index. Now, the CRB has been bouncing back and the S&P has been under some pressure, but longer term, this continues to be in an uptrend, showing that the S&P is outperforming the CRB index. Here's an inverse of that same chart, where the CRB has been underperforming, but starting to bounce back. We look at the NASDAQ 100, which are really big companies in the NASDAQ, which has been doing quite well in 2023. We compare that with the S&P 500, which also has the mega caps in it, but on a ratio basis, the NASDAQ 100 is still outperforming the S&P 500. We look at the biggest stocks that make up the S&P 500, which is the S&P 100, showing that they are outperforming the rest of the S&P 500. We look at the NASDAQ, which has been doing quite well in 2023, and the S&P, which has also done well, but the NASDAQ is outperforming the S&P. The NASDAQ 100 and the NASDAQ, which both have had pretty good years so far, but when you look at them on a ratio basis, the NASDAQ 100, which has the bigger stocks, they continue to outperform. We look at the mega cap growth, the really big companies, and compare them with the equal weight S&P 500, showing that the mega caps are really outperforming. And that's pretty much what you've been hearing if you've been paying attention, that it's just a group of a few really big companies that have been holding up the market. And if you have stocks outside of that, you might not be having a very good year to this point. We look at a ratio between small caps and the S&P, that's the red line, where small caps are really underperforming. When we see this red line going up, that suggests that the whole climate is more positive when we compare it to the blue line, which is the S&P, and we're just not seeing that right now. So this is something we have been watching, but we want to keep watching this overall. We look at a ratio between the small caps and the S&P, showing how the small caps continue to underperform. We look at the biggest software companies where they came down to their 200-day moving average. They're coming back up to their 50 and then starting to come back down, even though they're in a longer term uptrend. We want to see this really break out and continue to go up if we're going to remain positive. Mega cap, these are the real monster companies. They're continuing to be in a longer term uptrend. We look at robotics and AI as an ETF, and that's all the rage right now, but that ETF has not been performing all that well. And when we compare it to the tech sector, it's been even underperforming and going down in relation to the rest of the tech sector. We look at the Dow Jones Composite Average, which takes the Dow, the transports, and the utilities and puts them together. It looked like we were breaking out here in late spring, early summer, and doing quite well, but then we started to run into some trouble in late July, early August, and this has been coming back down. However, longer term, it's in an uptrend, but we want to see it break out of this sideways pattern that it's in. We look at the S&P 500 and compare it with shorter term bonds ranging from 1 to 3 years based on price, where even though it's falling back right now, this ratio continues to hold up. We look at a broad market measure and compare it with further out bonds, suggesting that stocks are continuing to outperform even though we've been falling back a bit recently. We look at low volatility stocks, which held up much better in 2022. They're continuing to chop sideways in 2023, and if we stay below these moving averages, we could see a death cross develop. We compare the low volatility stocks to the S&P, showing how in 2022, low volatility stocks outperformed, which means they may have gone down less than the growth stocks, where in 2023, the low volatility stocks are underperforming, where growth stocks have been doing much better. And we're coming down here to what could be near a double bottom. See if we're going to break below this or bounce and start to go back up. We look at the tech sector and compare it with bonds, showing how the tech sector has been outperforming, even though it's been falling back. The tech sector has been under pressure recently, and bonds have been under pressure, but the tech sector has been under a little bit more pressure, so that's why we're seeing this ratio decline. We look at the S&P and other stocks. First, we look at the advanced decline line studies for the NYSE, where they're showing some weakness. We're dropping below the moving average with the S&P, the mid caps, and the small caps are continuing to show more weakness than the other indexes. We keep an eye on Dow theory, where the Dow was actually up on Friday. It was the only index to do that. But what we're really focused on are the transports, which is in the middle. And it looked like they were breaking out. And when the market was really doing well, we saw the transports doing well. But now that they've come under pressure, we're starting to see the indexes come under pressure as well. Utilities, which have been really underperforming, well, late last week, they saw a real surge and are showing some improvement. We look at a ratio between the transports and the S&P. When this is going up, that means the transports are outperforming. When this is going down, that means the S&P is outperforming. And this is going down, which is more negative. Then we look at the Dow to transports ratio. When this is going up, that means the Dow is outperforming. And that's what we're seeing right now. We want to see this ratio actually go down if we're going to look at it in a more positive way. We look at the correlation between the S&P and the transports, where they typically will have a pretty strong correlated relationship, but lately we've been seeing them going in opposite directions. We look at a new take on Dow theory, where instead of looking at the Dow, we look at the S&P, and instead of looking at the transports, we look at the NASDAQ, and this just gives us an idea of where we're at right now. We're not really seeing anything all that strange. We look for either divergences or convergences in this chart, specifically when we're trying to break out, and we're not really seeing that now. The FANG index, which has been holding up fairly well. This is a daily chart, and we're still above the 50-day moving average, and we're still in a longer-term uptrend. This is Facebook, Amazon, Apple, Netflix, Google, and a host of others that have been added to this index. Then longer term, we came back earlier in the summer and set an all-time high. Well, since then, we've fallen back down this red line, which was a previous high, and we've been coming and falling down a bit. We're trying to show some recovery now, but we want to see, can we get back up and break above the red line and then eventually go back and set a new all-time high? ARK, which is a real popular investment with some folks, well, it hasn't been so popular when it was really declining. It's still in a longer term uptrend. It came down to its 200-day moving average and has been seeing a little bit of a bounce, but it's still below its 50-period moving average. Then we look at the S&P on a monthly chart, and we compare that with stocks in Europe, Australia, Asia, and the Far East. We're above this red line, showing that we're in a longer term uptrend. And the PPO, the percentage price oscillator, it's going above zero. So longer term, this is showing that we are turning more positive. We compare stocks with bonds, where we're starting to see some real pressure on bond prices, and that's making our total bond ETF go into a downtrend. We look at world bonds, also going into a downtrend and possibly breaking below this red line, which had been a previous low, and often it had acted as support. And then we compare stocks to bonds on a monthly chart, showing that even though both bond prices and stock prices have been under pressure, stocks continue to outperform. Then on a shorter term basis, we're showing how bonds are underperforming stocks. Then we look at different types of bonds, like high yield bonds, which you can also call these junk bonds, where they're continuing to hang in there pretty well. They're in an uptrend, and they tend to follow what the stock market is doing. Then to get another look at this, investment grade bonds, which are more conservative, they're chopping sideways now, and we're starting to see a death cross here with this based on price. So that's turning a little bit more negative. But when you look at riskier bonds, which of course they have more risk, but they also give you more of a yield or more of a return, and compare them with more conservative bonds, folks are still tending to prefer the riskier bonds. They're willing to take on that risk. If they were getting really nervous, we would see this ratio going down. They still seem to have some confidence, at least based on this chart. Then we look at a correlation between stocks and bonds, and they're having a fairly strong tendency to go in the same direction. When we look at charts like this, when we're above 0.25 and rising, that means the two instruments that we're measuring are going in the same basic direction. When we drop below minus 0.25 and continue to fall, that means they're going in the opposite direction. We look at the Dow Jones Corporate Bond Index, which has really been chopping sideways enough now to where we might get to the point where we see a death cross in this ratio, in this index very soon. We keep an eye on yields, where we're starting to break out a little bit with the 10-year yield. This is something we're watching pretty closely, especially as we continue to break above the 4.02% level. Then we're also seeing this longer term, and Chris Shavako from Shavako Capital, who puts out a really good video that's worth watching every week, where for 40 years we have been seeing a series of lower highs and lower lows as interest rates are going down. Now we're starting to break back out to the upside, and we're starting to wonder, are we going back to the old normal, where the new normal was this decline? Are we going to come back into an environment like we saw maybe in the 60s or 70s, where interest rates tended to be higher on a relative basis? Well, we don't really know that yet. Right now, it looks like that could be happening, but we'll just have to see this played out. Looking at the 30-year bond yield, where we're above the 61.8% retracement level and still rising with interest rates. And then we compare stock performance with bond performance, where we're starting to see a death cross here. We had been seeing the S&P outperforming the rise in interest rates. Now we're starting to see that go in a negative direction. We keep an eye on junk bonds, which continue to be in an uptrend. We compare junk bonds with government bonds, showing that junk bonds are outperforming. And then here's a price chart looking at an ETF where we're below 50 with the RSI. We've seen a recent death cross, so price is trended down. The MACD had been positive, and it's still positive, but it could continue to roll over if we see a further deterioration of bond prices. We look at a daily chart of the yields, just showing how they're changing on a day-by-day basis, where we had been going down, but then over the last week or two, they've really been going back up. Late in the week last week, we saw them go down slightly. We look internationally at a weekly chart, where the UK, even though it's been falling, they still have the highest interest rates, followed by the US and then German rates. And then we also follow the Japanese rates. We look at the 5-year yield and do a study where it's above this moving average. This is a little bit difficult to understand right now because we're clearly in an uptrend with yields, but the the special K is showing that we're in a longer term downtrend. And I'm not quite sure that's why. I mainly look at the top part of this chart. And then at the bottom, we look at another momentum oscillator, the KST, which is also showing some weakness. We look at the 5-year yield and look in the short term where we're pretty much flat. In the intermediate term, we're going higher, but in the long term, we're going lower. But that seems to contradict what we're seeing in this chart up above, where yields have been continuing to go up. Then we look at bonds based on price with their long-term yield, where they're below the moving average and declining. So in the short term and intermediate term, we're declining. And again, it's a little bit misleading as to why is the long term still going up when we can still see that prices are continuing to fall. Then we look at the MOVE index, which measures the volatility of bonds. In the middle, we look at the VIX, which measures the volatility of stocks. And then we take a correlation between the two, and they have a pretty strong tendency to go in the same direction. We look at a monthly chart of the 30-year price of the Treasury bond, where it's continuing to decline. But when we compare it to the CRB index, even though the CRB has been coming back, it's still underperforming longer term when we compare it to the price of bonds. We look at the S&P in different sectors. We just do a flat out ratio between materials and the S&P. Materials are underperforming. Communication, which has been one of the stronger areas in 2023, it's outperforming. We look at the energy sector, which has been roaring back lately, but still is in a longer term downtrend. The financials, which we had the problem back in March, and they still continue to underperform. Industrials are also in a downtrend. Tech, which has been doing quite well, it's in an uptrend. The staples have really been suffering a lot lately and are in a downtrend. Real estate, which continues to be in a pretty solid downtrend. Utilities also bounce back later in the week, but continue to be in a downtrend. And then the ratio between the two, we look at the S&P to utilities. When this is going up, that often gives good support to the S&P, but we've been seeing this throughout the month of August, and it's really not giving that much support to the S&P. Healthcare is also in a downtrend compared to the S&P. Here's another look showing how healthcare is underperforming. Discretionary, which is more growth oriented, that's continuing to outperform the S&P. And the staples sector, which is chopping more or less sideways, it's still positive, but if we stay below these lines, that could turn negative soon. The tech sector continues to be in an uptrend. Semiconductors, which have seen some recent weakness, but are still in a longer term uptrend. The tech sector to the S&P shows that the tech sector is outperforming. And energy, which had been underperforming, is now starting to come back a little bit, but still in a longer term downtrend when we compare it to the tech sector. We look at growth, which has been outperforming bonds. And the tech sector to the rise in interest rates, we've been chopping sideways now, showing how the tech sector has been outperforming. But if we still see weakness in this ratio, we might see a death cross soon. And here's an inverse of that same chart, showing how the rise in interest rates has been underperforming, but we want to keep an eye on this one. Then we look at discretionary to staples, showing how in the early part of the summer, discretionary started to outperform staples. Here's an inverse showing how staples are underperforming discretionary. Gold, even though it's in a longer term uptrend, is underperforming the S&P, and gold is also underperforming the dollar index. High leverage loans, these are very risky, and they still continue to do well. As I say every week in this video, these are some pretty smart folks that invest in this. And if we were getting ready to really have trouble in the economy, this ratio would be going down. I'm sorry, this is not a ratio, this is an index. This index would be going down instead of going up. We look at a broader measure of the market by the NYSE composite. That's continuing to be in an uptrend. All stocks are also in an uptrend. Emerging markets, we're chopping around a little bit, still in a longer term uptrend, but if we see some weakness here, that could turn to a downtrend. The micro caps, which have been under pressure lately, earlier in the year, they set a new 52-week low and then bounced up off of that. They're still in an uptrend, but we could be beginning to see more of a death cross if we see some more weakness in these very small stocks. Then we look at the home builders. We're not seeing anything really peculiar right now. On the top, we have the S&P and then the home builders ETF. We take a ratio between the two. And then what I follow closely is the correlation down at the bottom, showing that they're having a strong tendency to go in the same direction. We look at Bitcoin, where it had finally seen a golden cross earlier in the year. Well, we got above 30,000 and now we're dropping down even below 26,000 and we're starting to see a death cross, but it hasn't quite happened yet. Then we look internationally, where China is starting to turn back up. Emerging markets are turning up. We're seeing Europe trying to recover. We're pretty much flat, but showing some improvement in Japan, and we're trying to show some improvement with the S&P. We look at InterMarket Analysis, the name of this video, going back to the beginning of the year, where stocks are still doing the best, followed by oil, and now the dollar has overtaken gold. And then since about the beginning of August or so, bonds have been going negative when you go back to the beginning of the year. Some correlations that we look at. We compare the S&P to the US dollar index. They're having a slight tendency to go in opposite directions, and that has been putting some pressure on the S&P. S&P to oil also. They can go in the same direction, but if it lasts too long and oil rises too much, that can cause some problems. We're getting back to neutral now, but if we start to see this really fall, the correlation, and see them going in opposite directions, that could, especially if oil continues to go up, that could put more pressure on stocks. And then we compare the S&P to the 10-year yield. They're having a pretty strong tendency to go in opposite directions. We look at the tech sector to the 10-year yield. They're getting back more to neutral now. And we compare the S&P to the 2-year yield. They're having a pretty strong tendency to go in opposite directions. Then some long-term secular, which means decades, or cyclical trend studies. Cyclical might mean years, where we look at a monthly chart of the NYSE composite, where even though we're seeing some weakness, we're still above the moving average. And the Kopic curve, which is another momentum oscillator, continues to be positive. Then we look at the NYSE and compare it with the NYSE record high percent index. It is turning down a little bit, so that's a bit of a concern, but longer term, we continue to go up. Then we look at the S&P, and on a longer term basis, even though the PPO is rolling over, it still is positive, and the S&P is still above the moving average. Then we compare the S&P with the CRB index. Even though we're seeing some weakness in the S&P and strength in the CRB, longer term, the S&P is still outperforming. We look at the S&P and compare it with a global index where we're above the moving average and advancing. We're seeing a little bit of a contradiction here where the KST is showing this declining. I would pay more attention to the price chart and the moving average. So at the end of this, I go through and I say what's positive and what's negative. My definition of positive is when the 50-day simple moving average is above the 200-day simple moving average. We have the growth indexes and ETFs. They're turning positive. The CRB index, the big software companies, the euro and the British pound compared to the dollar, gold and silver, the mega caps, the S&P low volatility ETF, the Dow Jones Composite Average, the FANG index, as well as ARC, and then bonds, the high yield and investment grade bonds, corporate bonds and junk bonds, staples, tech and the semiconductors, high leverage loans, the Dow mid caps and small caps. Even though they're seeing some weakness, they're still in longer term uptrends. The NASDAQ and NASDAQ 100, the NYSE composite, all stocks, emerging markets, and then we're getting possibly close to a death cross, but the Bitcoin index is still positive, at least for right now. What is negative? This is when the 50-day simple moving average crosses below the 200-day simple moving average. The value indexes are still negative. Copper is negative. The dollar index is negative. The Japanese yen to the US dollar, the total bond ETF, world bonds, the micro caps, the really small companies. And thank you. Sorry, I'm not editing these videos, so sometimes I get caught off guard. So I hope you found this helpful. I hope you're having a great weekend. Please feel free to check out my other videos, and I will talk to you in the next video.